Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial investment and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here once again, ladies and gentlemen, on your Game Plan for Retirement. McIntire Retirement Services is home of the Game Plan for Retirement, the written document helping you plan for your financial future. And Chris, we always appreciate your time here on the program talking about what we should be planning for and how we should approach these factors.
Yep, a lot to talk about today, Peter, so looking forward to getting started.
Yeah, well, we want to talk a little bit about managing market risk on today's program. And while we've enjoyed a reprieve from the volatility and the losses that we saw through 2022, it doesn't mean that the market will not continue to be volatile into the future. And I think investors are rightfully concerned with the potential for volatility. I mean, after all, Chris, for the majority of the year thus far, we've heard this talk of recession that we may be heading into, but so far, so good. The market has sustained and been able to avert that kind of recessionary trend.
It sure has. The housing market's still staying strong despite rising interest rates. And, there's obviously pockets of weakness around the country, and there always is. Some San Francisco, that tech sector, is not wanting to come back to the office space. That's affecting the commercial real estate market. And then, I think it's fair to state that they do some things different in California than they do here in the Midwest. And, with homelessness and crime that, is affecting the real estate market and the housing sector out there as well. But, overall here in the Midwest, we typically don't go way up, don't go way down. It's a little more of a balanced approach here. But when we look at the overall equity markets, we thought maybe the international side would take off this year, and here we're doing quite well in the U.S. markets. The Russia-Ukraine piece that we've been talking about here for a year and a half, hasn't really, did not freeze out the Europeans, with the energy crunch and whatnot. And, our shift to different types of energy, ESG pieces, things that are out there now, we probably have a lot more politics involved in our investment, decisions than we ever did before based on, corporate, covenants and whatnot. And, just the political pressures that are put on everybody these days aren't what they, once were.
Yeah. I was going to say more than ever, we're hearing about how the politics or social agendas are intermingling and mixed in with the investment piece. And some firms have followed that trend. Some firms have been pretty avidly against it, but it is probably a trend that we will continue to talk about into the future for quite some time. And Chris, I know that is something that you talk about with your clients. Now, there is, throughout our investment career and time span, always a discussion of risk and risk versus reward, that we've been taught that in order to get the growth that we need to invest our money. We need to take some risk with it. You've also talked at length on this program about safe money strategies. So there's got to be a balance there. I guess let's back up and from a high level view, start at the top and then zoom in. From that high level view, what is risk? When we talk about taking risk with our money, how do you qualify, quantify, or define that?
Yeah, so I think, if I'm listening to the show out there today, people are probably thinking it's about stock market risk, the price of stocks coming down in value. Okay? We could also put that over into the bond market. They raise interest rates, that pushes down bond prices on bonds that are already out in the market because new ones pay a higher rate than the ones that you might have in your portfolio. So obviously they can go down in value. But again, if you hold a bond until it matures, you get your, your face dollar amount back. So some of that is temporary.
But Chris, on that point, I mean, what was once considered to be the safer side of the investment portfolio, the more conservative bond or fixed income, does not necessarily represent safety, being more conservative, because we have and did see that side of the portfolio lose value.
Yeah, and some of the safest bonds out there, U.S. government bonds of a 10 or a 20 or a 30-year duration, lost 20 to 30% last year. So you're right, Peter. Nowadays we could walk into a bank and get a CD at 5%. Basically, we can buy a fixed annuity at 5%. So we can do a lot of different things to get rid of that interest rate risk in bonds. Stocks are always going to have some type of risk to them. And if you're in, the tech sector, those are going to be a little more volatile typically than, a Coca-Cola. That's a good solid dividend payer, right? Some of those are a little bit more steady. So, depending on how the market is trending, will also help you determine on, which part of it do you want to be in? Can you stomach the risk of the tech sector and the volatility in the prices? If you have a longer term time horizon, certainly. If you can't, then that's where you kind of back down. You might look at the dividend payers and say, look, if nothing else, I'm going to get my dividends and I'm going to go out and that's what's going to buy my lunch in over the course of the next 10 years. I can handle that part of it because I know I'm getting the dividend. If we look at inflation, right, inflation risk, that's what we had when we have money sitting in a savings account making nothing. If inflation is 4 and 5% a year, and you have $100,000 sitting in a cash account or in your safe at home, it's got to make 4% so that it can buy the same things it could the year before, or you've essentially lost purchasing power. So inflation risk, interest rate risk with bonds, stock market risk, and those are just a couple of them. Obviously, we could probably expand this out into the health risk as well that people have. That, hey, I had a stroke. You and our good friend had a stroke at a very young age, and isn't going to be able to work anymore. And at age 58, not many people are ready to call it quits by any stretch of the imagination. So, and how do we mitigate these types of risks? There are ways to mitigate or to minimize them.
I appreciate you recapping that and cycling back, Chris, because what I heard there is that you started that most people probably on a surface level, when talked about risk, when hearing that, think of market risk, but then you gave the example of U.S. Treasuries, long-term Treasuries, which are considered to be some of the safest things, having their own risk, which in fact, that led to some of the problems that we saw with the banking sector, Silicon Valley Bank and First Republic and that handful of banks, which are also generally considered banks to be very safe and secure. But that speaks to time being a risk, inflation being a risk, health being a risk. So a much broader definition of risk when we're talking about our money than simply the ups and downs and the volatility of the stock market.
Yeah, no question about it. Look, and the markets can drive us all crazy at times, trying to and that's why you find wherever your balance point is, I'm a pretty aggressive investor because we don't need the money right now. So I don't pay much attention to it. I'm buying what I like to buy and continue to do that and don't look at it every day by any stretch of the imagination. Because most people make emotional decisions, not logical decisions, right? If we all made emotional decisions, we'd drive the safest vehicle out there that was fluorescent yellow so everybody could see us, but we know that's not the case. And on the healthcare risk, God forbid if somebody, survives the stock market risk and ends up, with more money at the end of the retirement than what they started with because of some financial success and investment success, but goes into a nursing home and starts having to write a check for $8,000 to $10,000 a month and ends up broke, they still didn't win the game. That's a risk that you have to hedge as well. It's just not, Amazon falling by 40% in 2022 that's going to derail your retirement. It's ending up in a nursing home facility or home care where you're paying big money out of pocket. And I'm telling you from firsthand experience, if you want to stay in your house and you need 24/7 care, you're talking $15,000 to $20,000 a month. It's cheaper to go into an assisted living facility or, God forbid you had to go to full-blown nursing home than it is to stay in your house with 24/7 care. And not many of you have children that can be with you 24/7 for a 4 to 8 year time frame. That's just not reality, no matter what you tell me.
Well, Chris, clearly we face a number of risks that we need to plan carefully to address. We cannot control or eliminate all factors there, but we can minimize several of them. We can eliminate some of them. And that is what planning is about. And getting that plan together, ladies and gentlemen, is what's going to provide and give you more confidence moving into your financial future and facing a myriad of variables and risks and addressing your income, your investments, your taxes, healthcare, legacy. That is what the game plan for retirement helps you achieve and accomplish. The variables that can impact and affect each one of those and eliminating or minimizing them where possible. If you'd like to get your plan put together, pick up the phone, give Chris McIntire, your resource, a call at McIntire Retirement Services, 800-868-1194. That's 800-868-1194. 800-868-1194. You can also visit online to get the conversation started at McIntireRetirementServices.com. McIntireRetirementServices.com. Chris, I'm going to circle back to maybe the market risk in particular, because that is something that we are told along the way that we should be taking. It seems like all other factors that we talked about, it's like, well, don't take risk there or minimize risk there, but we're actually encouraged to take more risk with the market and with investing. So let's talk about that one in particular for just a moment. When we are told we should take risk, okay, well, the next question is how much? So is there any kind of formula or rule of thumb that you can help to quantify or define what that level of appropriate risk is with our money and our investments?
Sure. We do an overall risk profile. We have a questionnaire. We can use some software programs like Riskalyze that, help people to do it in real time and see the visual impacts of, what a sharp market decline could do to them. And then, we kind of get a score for that, of course. And then around that, so let's say it's a moderate investor and they want to stay, that's typically going to be 60% stocks, 40% some type of bonds, and you can mix and match the type of stocks, mix and match the type of bonds and incorporate a core portfolio that says, okay, hey, here's a basic index type portfolio where we've got a bond index and several stock market indexes. And then maybe we add some other, call them a satellite position. Like this year, it might be a technology fund to help boost the stock side. And then maybe you just include a money market on the bond side. That's, believe it or not, short-term bonds are paying more interest than long-term bonds. So you could probably find a 4.5% yielding money market account out there. That's got very little risk to it whatsoever.
Chris, is that a good thing that short-term rates are paying more than long-term rates? I've heard kind of mixed things about that. People happy that they can get those higher rates and not lock in their money for a longer period of time. But I've also heard that is generally an indicator of less confidence in our long-term stability.
Yeah, it truly is. Typically we're taking more risk on something in the long term, so we should get a higher rate of return on something that's got a maturity in 10 years, like a 10-year government bond should pay more than a 2-year government bond, right? How much risk am I taking in 2 years versus 10 years? What are the things that can happen? So we've been in what they call the yield inversion, where we're making more interest on 2 years versus 10 years because we're not sure what's going to happen in the long-term time horizon. So we would like to see, that's typically a sign of a recession when we make more interest on 2 years versus 10 years. And so hopefully that yield will, undo itself. But, with the rising interest rate environment, that's probably going to be, further down the road into 2023 and potentially into first or second quarter of 2024 before that would unwind, given the fact that we might not go into recession, all things, putting all the cards on the table there. A lot of things can happen, obviously.
There are a lot of factors. There's global factors, there's situational factors, there's market and business cycle factors. All of these play into the equation. I do understand, Chris, but another one is more individual and personal, and that's kind of our own unique risk tolerance, right? If we are conservative minded, if we are more aggressive, you've mentioned that factor, but that's going to play into the amount of appropriate risk that we should be taking, and probably also our timeline. A 25-year-old probably a very different appropriate level of risk than maybe a 55, 65, or 75-year-old.
Yeah, no question about it. Like I said before, I'm a pretty aggressive investor, very little bonds in our portfolio. I got a little bit of cash in a money market for the emergency fund, got the emergency fund, but pretty much an all stock type person for myself. I do like dividend yielding pieces, and in today's interest rate environment, hey, you can leverage and, put some money in a CD or a basic 1 or a 2-year or a 3-year annuity and make north of 5%. We haven't been able to do that in forever. So portfolio construction has, I won't want to say gotten easier, but there's more options available right now to create some yield. And here, if you want to think about it this way, you got somebody that says, look, I'm pretty conservative. I want to stay conservative. Well, you could take all that yield, all that interest and dividends off your conservative portfolio and buy stocks with them, on a monthly or a quarterly basis. That way, when the market takes a dip, your dividends are going to buy more shares of stock and you're not interrupting your key portfolio. We help a lot of people with their 401ks in that regard to say, hey, you know what? I want to keep the balance of my portfolio, my 401k, safe, but where should I be putting my contributions? And maybe the contributions can buy stocks because you dollar cost average. Again,
that risk factor. Okay, yes, we do need to take some level of risk, but there are also smart ways to do it. There are strategies that can help us within that risk profile to take advantage of more of the upswing, Chris, within our risk tolerance during good periods, and then decrease the impact of downturns during more challenging periods. These are some of the financial fundamentals that we talked a little bit about last week on the program, but I think these things play heavily into the appropriate level of risk that we are taking if we are doing these fundamental things or if we are not doing these fundamental things, correct?
Yeah, absolutely. And, we're doing some different portfolio construction right now for all of our clients here between now and the end of the year, essentially, because we're going to create some different portfolios that are, built around the interest rate environment that we can get, and increasing yield, increasing dividends, some preferred stocks we'll use, some structured notes that we use, and help create more investment income that can certainly be used as income or reinvested and buy other instruments as well. So, I call it getting work for your money. Dividends are work. Interest is work. So right now, we have the ability to get a fair amount of that. So let's get some of that going and put that into work for folks for future returns. That's what happens when bond prices fall and interest rates increase. Is you're gonna, if you're gonna continue to stay in bonds and whatnot, you're gonna get future higher rates of return as bonds mature inside the mutual fund and they buy newer bonds that have a higher interest rate. You will get future higher rates of return. It doesn't happen overnight like most of us are, or I shouldn't say us, but that most folks are conditioned to, I want an immediate reaction and it should happen tomorrow. It doesn't,
Yep. It is a long-term game here, but I know that, Chris, over time, the market has been a powerful tool for wealth growth and accumulation above and beyond the rate of inflation. Now, Those things sometimes don't happen simultaneously. And there are periods of time where inflation may outpace the market, or even the market has a downturn. But over time, if we utilize the tools, the strategies of the market, and do so wisely with a plan in place to give us some amount of discipline, Chris, I know that you have the tools available. You help people structure, put that plan together, and help them stick to it. A bit of accountability there, as well as a sounding board, so that we are not reactionary to the ebb and flow and the whims of the market. That is the formula for long-term financial success and lasting confidence, even when the paycheck is far behind us.
Yeah, it truly is. And, there's been a lot of talk of slowing growth here in the United States. And, look, we have a lot of legislative risk out there as well. And, and the current administration loves to legislate, and, they make cost of doing business more expensive for lots of corporations that have to adhere to new environmental regulations. That slows things down. So there is a cause and effect to all of this. It's not like the government waves a magic wand and everything goes away and is perfect. That's not how it really happens. They're often a detriment, and that is what we're seeing right now.
However, Chris, on the opposite side of that, I think people are rightfully concerned about those periods of time, maybe short, sharp term declines, maybe more prolonged periods of market retraction. The downside of risk, the real potential of losing money in the market, even a short period of time at the wrong time in our personal cycle, can be detrimental to our forecast and outlook, especially for retirement within the first few years or directly leading up to retirement. That is something that you've talked about being an important factor to be cognizant and aware of if we are making that transition and taking risk with our funds.
You know it, buddy. And Peter, we've been doing this show for forever, it seems. And I did it with Brian Liskey prior to this for, more than 10 years. And it's like, that's why you have a safe money strategy, right? Because you're going to be disappointed, at times in the market. And that sometimes that's a short-term disappointment. Sometimes it can be a long-term disappointment. That's why you have another alternative in place. I'm going to call it a plan A. Plan B is your investment side. Plan A is your safe piece with an investment piece to it, not just an investment only strategy. Stocks, bonds, and mutual funds at some point will disappoint you greatly, like in 2022.
Well, ladies and gentlemen, if you would like to get that plan put together, maybe a plan A, a plan B, and potentially a plan C and D and beyond, but having that plan in place that addresses your investments, your income, your taxes, your healthcare, your legacy planning for your financial future, for your confidence and well-being into and throughout retirement, pick up the phone and give Chris McIntire a call. He is your resource to get that written game plan for retirement, the document that will help you address the factors, the variables, the risks, the issues, and opportunities to plan efficiently and effectively. That is the game plan for retirement, a complimentary service there at McIntire Retirement Services. Pick up the phone now and give a call. 800-868-1194, 800-868-1194, 800-868-1194. Chris, you've got a little list of a sound approach to volatility. Number one on that list, don't panic, remain calm.
Yep. Most people want to panic. It's an easy thing to do. You're emotionally involved. You're seeing your hard-earned dollars, I'm going to say appear to evaporate. They do not. That number on your statement is just what happens if you were going to sell them that day. That's what they would have been worth. Okay. So, it's not as bad as what it can seem. And you have to, if you don't have a stomach for it, then you maybe want to look at some other alternatives.
But number two on the list, Chris, don't be too greedy.
Yeah, be careful. Yeah, being greedy can hurt, and when do you take your gains? Like, that's why you rebalance, because rebalancing helps you avoid being greedy, because, being greedy sometimes bites us all, right? Yep. I think it's going to go up another 10% and then it falls by 20.
Indeed. Be informed, stay informed. We should be paying attention to our investments, to our money.
Yeah, no question about it. Doesn't mean you log in and look at it every day or even every month. That's where you want to do your quarterly type of a rebalance, or, meet with your investment advisor on a quarterly basis, make sure things are on track, or, even twice a year sometimes is just fine.
Have some accessible cash. Chris, why does this help us balance risk and be more successful investors?
Because life is what happens to plans sometimes, and bad things can happen. We had 14 tornadoes go through here, a couple of weeks ago, Peter, and, people are going to need immediate needs for cash until they get insurance settlements, if they have to go out and buy a car quick, or, just all the things. You got to buy new clothes, for example. And, that was a day they weren't even predicting any bad weather. And, my wife and I were wearing bicycle helmets underneath our stair steps,
Rebalance, Chris.
Yep.
Rebalancing is one of those fundamentals that's going to help us be more successful long-term investors.
Sure. Yep. If you're a 50-50 portfolio, you need to monitor the stocks and bonds to make sure that they stay in a 50-50 range, and do that, on a quarterly or a semi-annual basis to make that happen. And that helps mitigate risk and volatility.
You have several others, but Chris, I'm going to circle to have a preservation and safe money strategy. Chris, why is having this going to allow us to be more successful investors with the risk that we do take?
Yeah. So in 2022, perfect example, we've talked about it many times, investment portfolios down 15 to 20%, for example. Even on a moderate portfolio last year, if you had a safe money strategy and you needed money, you could go and take it from there and leave the 60-40 portfolio some time to recover. Take the pressure off of it, plain and simple. At some point, you're going to need to have and utilize a safe money strategy.
Yep. Protecting your income. If you have enough, don't take unnecessary risks, just a couple others. Don't gamble with money you can't afford to lose. And then, Chris, the list ends with get a review, and now may be the best time to do that.
Yep. Let's take a look at everything that you've got and kind of see if we can find some holes in the bucket, and what are the best methods to patch those holes.
Well, again, ladies and gentlemen, if you would like to get that plan put together, if you would like to look at strategies to help optimize your confidence into and throughout your financial and retirement future, get that game plan for retirement put together, get that review, have a conversation about your money and how it aligns with your financial goals. Now, with Chris McIntire, you can do so. No cost, no obligation for listeners to this program. You've been hearing Chris McIntire on the radio airwaves for years here across Northwestern Ohio. Now's a best time as any to give a call and take advantage of the offer and the opportunity to have the conversation, to get your money aligned with your goals, to get your game plan for retirement put together and in place. Give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, we appreciate you being the constant resource for important discussions and information about our money, our investments, our finance that you consistently provide. Thank you for being here for proactive savers and investors across Northwestern Ohio.
My pleasure. Thanks for listening, everybody. Stay safe out there.
And again, ladies and gentlemen, you've got a great resource in Chris McIntire and the team and family at McIntire Retirement Services. Give them a call. Get that conversation started. 800-868-1194. That's 800-868-1194.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.